Have you ever thought about investing but didn't know where to start? Well, you're not alone. Investing can seem like a complex labyrinth, but with the right guidance, it can be your golden ticket to financial freedom. Investing is the act of allocating resources, often money, with the expectation of generating an income or profit. It's about making your money work for you instead of you working for your money. The magic of investing lies in the power of compound interest, which can turn a modest sum into a substantial one over time. But, like all good things in life, investing comes with its fair share of risks. The value of investments can go up or down, and there's always the potential of losing money. That's where the importance of building a diversified portfolio comes in. By spreading your investments across a variety of assets, you can potentially reduce risk and increase your chances of earning returns. Stay tuned to learn the steps to build your own diversified portfolio. Now, you might ask, what is a diversified portfolio? Well, let's delve into this. Picture an investment portfolio as a pie. Diversification is the art of slicing that pie into various pieces, each representing a different type of investment. This could be stocks, bonds, real estate, or even commodities like gold. Why do we slice the pie? To spread the risk. If one slice doesn't perform well, you still have the other slices to fall back on. It's like having a safety net for your investments. When you diversify, you're essentially saying, I don't know exactly which investment will perform the best, so I'll invest in a variety. Common types of investments used in a diversified portfolio include stocks for potential growth, bonds for income, and real estate for stability. Each of these has its own risk and reward characteristics, and together they can help create a balanced investment portfolio. With diversification, you're not putting all your eggs in one basket. The first step to building a diversified portfolio is setting your financial goals. Now, this may seem like a no-brainer, but it's surprising how many people skip this foundational step. Your financial goals are your compass, guiding you through the complex world of investing. They could be anything from buying a house in 5 years, saving for your child's college education, or amassing a retirement nest egg. These goals will influence your investment decisions, determining what assets you invest in, how much risk you're willing to take, and your investment timeline. If your goal is short-term, you might lean towards safer, less volatile investments. On the other hand, if your goal is years away, you could afford to take on more risk for potentially higher returns. So before you jump into the exciting world of investing, take a moment to define your financial goals. Remember, your goals should guide your investment decisions, not the other way around. The second step involves choosing your investments. Now, this might seem like a daunting task, but it's all about understanding your options and aligning them with your financial goals. Let's start with stocks. When you buy a stock, you're buying a small piece of a company. You become a shareholder and you can potentially earn money through dividends or by selling the stock at a higher price than you bought it. However, stocks can also be volatile, meaning their prices can fluctuate dramatically in short periods. Next up, we have bonds. When you purchase a bond, you're essentially lending money to a corporation or government entity. In return, you receive regular interest payments and the bond's face value when it matures. Bonds are generally considered safer than stocks, but their returns are often lower. Thirdly, there are mutual funds. These are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Mutual funds can provide diversification and professional management, but they also come with management fees and potential risks. Lastly, let's not forget about real estate. Investing in real estate involves purchasing properties, either to rent out for income or to sell at a profit. Real estate can provide steady income and potential tax benefits, but it also requires significant capital and can be illiquid, meaning it can be difficult to sell quickly. So how do you choose between these investments? It comes down to your financial goals, risk tolerance, and timeline. If you're aiming for high returns and can stomach some risk, you might lean towards stocks or real estate. If you prefer steady income with less risk, bonds or certain mutual funds might be more your style. Remember, diversification is key. Spreading your investments across different types can help manage risk. You don't have to choose just one type of investment. In fact, a mix of all these can make for a robust and well-rounded portfolio. Choosing the right investments can seem daunting, but it's easier when you understand your options. The final step is to regularly review and adjust your portfolio. This is not just a one-and-done deal, it requires ongoing attention. Why? Because the market is a living, breathing entity, always changing and shifting. So what does regularly reviewing your portfolio mean? It's about monitoring the performance of your investments, seeing how they fluctuate in response to market conditions. Are they performing as expected? Are they helping you move closer to your financial goals? If not, it might be time for an adjustment. And adjusting your portfolio isn't just about reacting to the market, it's also about adapting to changes in your own life and financial goals. Maybe you've just had a baby, or you're approaching retirement. These life events could mean it's time to reassess your risk tolerance and investment strategy. So keep a keen eye on your portfolio, and don't be afraid to tweak it as necessary. Remember, investing is not a one-time event, but a continuous process. Investing may seem complex, but it doesn't have to be. As we've learned, the first step to investing is setting your financial goals. Be clear about what you want to achieve and by when. Next, choose your investments wisely. Don't put all your eggs in one basket. Diversify. This is not just about spreading your investments across different asset classes, but also within each class. After that, make sure to regularly review and adjust your portfolio. The market is dynamic, and your portfolio should be too. If an investment isn't performing as expected, don't be afraid to let it go. Remember, investing is not about getting rich quick. It's a marathon, not a sprint. Be patient, be disciplined, and most importantly, keep learning. There's always something new to discover in the world of investing. With patience, discipline, and a well-diversified portfolio, you can reach your financial goals. So start your investing journey today.